Our guest speaker is Mr. Venkata Meenavalli, founder and chairman, Stampede Capital Limited. Mr. Venkat is the techno-entrepreneur who invests and backs disruptive technologies on the internet. He is one of the key architects in defining the early stage of internet rollovers in Wall Street. Can we please welcome Mr. Venkata Meenavalli?
Good evening, everyone, and it's a really great session going on, and really I'm honored here to be here. Thanks to Sushil and everyone. And Stampede is my passion, like what you guys, I see the passion in you. Was started and funded by me in 2008 with a group of mathematicians. And I used to work in Wall Street before I came and started my first company as a venture. With the passion, 2008, a lot of my friends told, why you want to, like, and I was in a completely depressed mode, why don't you back it up? Why don't you start? We are all doing very well in Chicago and everywhere. Why don't you start your own trading, electronic trading things? Like, then that's how in 2008, with a group of mathematicians who are PhDs in math and stat and computer science, I backed and I said, I don't want to make money. Let's, next 5 years, be the time where we spend on the research. Let's get why a Renaissance, why a Citadel, why a Virtue Financials can do from US, why can't we do it from here? Today I stand here after 7 years. Stampede today is the largest market maker in SGX. We are now as largest market maker for some of the derivative contracts in CME. Now this month we are connecting to Eurex, DGCX, ASX, Hong Kong Exchange last week. They called Stampede, particularly the whole team, asking us to be the market makers on Hong Kong Stock Exchange. And today, apart from our Hong Kong Stock Exchange, we are connecting on May 18th to ICE, be the first market maker for ICE Singapore. The passion and drive today, we are the first Indian company on the global arena being the designated market maker. Today, this in a short time, thanks to my team also. And what I want to share is completely different what you guys are doing, but I really love technical analysis. I started trading my age of 17. And being in Wall Street, I made good money there. But it's life. I just want to show a couple of videos. You will understand what the industry is, and I will not take much time. So just can you help me to play one video? I will not take much time, because very interesting topics. I just want to tell you about the market, electronic market making, how the industry runs. I'm not here to educate, but I just want to give you the vision of the entrepreneurship of how the markets are run today, beyond what you guys think, how the charts. Sit there, Elvin. Yeah. Speaker better, no? Take.
It's the moment investors around the world wait for, the 9:30 opening of the U.S. markets. Inside Citadel's Chicago headquarters, it's eerily quiet, even though this firm trades more stocks every day than the New York Stock Exchange.
Now, yep, 2 minutes they open, so we're about to get going here.
Is there any equivalent of a bell that we're going to hear or see?
I have the world clock up there. That's about it. We're just going to hear the air conditioning above us.
The equivalent of the NYSE's opening bell is just this. Millions of orders that have been waiting all night for the markets to open are rapidly filled by Citadel's computer programs.
How do the books look, guys? So we're pumping through a lot of volume right now. You can see how quiet it is. The phone's not even ringing. Clients are happy. If there was ever an issue, obviously we would spot it first and the phones would light up. We have executed 21 million shares already.
Wow, and we are not even 3 minutes in. Meet the new Wall Street traders. Here, computers like these do the heavy lifting. Citadel's employees with PhDs in applied math, physics, and engineering build and refine the computer programs. And the people who manage the trading floor here mostly look for computer glitches and talk to customers.
They are not making trading decisions. Those are all made by the computers. So they're not making any decisions with respect to whether an order should be filled, what price it should be filled. That's all done in an automated way.
When you click send from your TD Ameritrade account, there's a good chance that Citadel's computers see it. Then they either fill your order or send it out to the Byzantine network of 13 exchanges and 20 plus dark pools to execute it.
Dark pool is really, it's an unfortunate terminology that the industry created, and really a dark pool is nothing more than a crossing engine. Now it's called dark because the whole market doesn't know what you want to buy or sell.
We've seen these market dislocations. Is it fair to think of it almost as a technological arms race?
Yeah, you know, I think it's no different than any other industry. 100 years ago, there were literally hundreds of car companies across the U.S., and there was a lot of smaller companies. Over time, manufacturing became very automated. You had factories, and you had the cost of building a factory went up. We are a technology leader. We make a big investment in technology to stay cutting edge, and yes, we're constantly investing in our systems to stay at the forefront of technology.
Just switch on the presentation. Before I jump into, it's a very short speech on electronic marketing, I just want to explain you the guys, the basic function of the markets are market makers who bring the balance to the markets. Basically, when the markets are in trouble, a lot of people, yesterday I'm having an interview with Economic Times. He asked me one question, why Venkat, why you need a market maker? A sudden news, a turbulence, a market going one side. Everybody in this room knows there is a trend line breakout. There is a divergence. Everybody knows, like, and everyone is selling. Who will put their capital to make the markets in balance? That is what is called a market maker. Who brings the orderly balance, who brings the flows to the market is the major function of a market maker. So being a market maker, the first condition of market making actually happened in Wall Street. Very interestingly, because the companies like Goldman Sachs, or the companies like Morgan Stanley, they subscribe to the IPOs like Facebook and all the things. So they deploy the cash. Once they deploy the cash, they have two equations, always a plus and a minus. That's how the markets start. Markets, you will never be, okay, you can be, there are two types of markets. One is to be a banking side, one is to be a punting side. Exchanges are casinos, market makers are the dealers, and the people who trade on the exchanges are the people who are punting in the market section. So to bring the orderly balance, first thing in the market making is never a banker ever takes risk in his life with his capital. The banker normally borrows the money from somebody at X rate and lends money to an X rate. That's what market maker always do. You look at, I was talking to yesterday, Sushil saying that, Venkat, whatever you do, people will lose money. Look at last month, there is an IPO happened called Virtue Financials for your reference. Virtue Financials has published to SEC a trading report of 1,260 days with 1 day loss, that too on a flash crash loss, which has to be stopped by their machines. They never lost because a market maker never takes the risk because it's a maker and taker. We take the flows and make the flows. Initially, how it happened? Initially, it's like you have two pairs, a plus and a minus starts the battery. That's what I call, because I'm a devotee of Shiva, like and I always say, mother and father, like in Shiva and Shakti, the universe is a combination of the plus and minus. This is Shiva, if it has a variance, that becomes the Shakti adds to it, the whole volatility starts to the things. When you have something long, you borrow it, and something I'll lend it, the spread is called net interest margin. That's what actually, how many times the markets are initially done by the people who are playing buy, sell, buy, sell, buy, sell. Now the market making has gone into nanoseconds. How many machines, like you can see in Citadel, at 3 minutes, they're traded like 2.1 crore, roughly. If you are making 1 cent, a bid and ask, a billion trades, a buy and sell, a day, per day there are firms in Wall Street who make $10 million a day by buying between a bid and ask every day. Like Getco, you can see, I'll show you in the report. Getco, every average trades, which is listed in US, average trades per day is around billion, and a round trip. So I'm talking about buy, sell, this is a law of large numbers. When you talk about law of large numbers, you will achieve that. So here the market making, what happens is, the market making brings the first fundamental, why market making was started in a continuous time. The first fundamental of derivatives is continuous time, e to the power of RT. The first thing is money has time value. That is the most important thing. Everyone in the room has to recognize that money has time value. Every second money moves. Every second money grows. Every second money compounds. So people don't understand, okay, I hold the share. Okay, then what if you don't trade? If the share doesn't move, you lost your money value. See, that's what the banks always say. Like, the banks make money by giving you a deposit 24 hours, they will be paying you. And when you buy a car like a Jaguar, bank finances you. But when you are sleeping also, you have to pay 1,000 rupees per hour. That means every second money is made. Whether the markets are closed or markets are made. The initial market making was done by firms who keep their capital. The capital on one side, the stock on one side. Now what happens? The next day the market moves. The percentage of the stock went up. I sell some stock, make my cash again, my returns are neutralized. So every time I'm making my returns neutralized, the market maker is impacting something. From that came in 1964, the put options came. From there, the whole market started evolving for the derivatives, the single stock futures. Now, you don't need a cash. Like, you can make a stock, you can sell a future, you can sell an option. Continuously, you have a pair. You need to have a pair to make money unless you are gambling on the market, directly buying the stock and betting on it. That's a different issue, which I don't want to discuss. But if you want to continuously be in the business, you want to make a business and make a living in the market, always spread is the one thing which you have to keep on making the spread. Borrow at something, lend at something. A stock at 8%, my cash, sell a future at 12%, make 400 basis points, or there is a cost, whatever you want, and you go and leverage the stock again, do it more times. Whether you have a positive carry or a negative carry. The whole thing, when you look at these type of returns, the whole market makers comes from three things. One is the spreading. Second thing is the cost of carry of money where they get, at what cost. Example, I was with a banker in Singapore last week. He said we gave a loan of $5 billion Venkat at 1% to Apple. I was shocked, like, sir, Apple is having $120 billion cash in their account. What made them to? Venkat, see, they bought the cash from the bank is Julius Baer. They said 1% we lended to them because they are buying their stock back, which is giving 4% yield. It's a positive carry in life. So everybody has to understand that you make more money you can also, but market makers means we have a huge capex, we deploy on the servers, co-located next minute, we aggregate the flows and we buy, sell. Even everyone, if you are spreading your things, it will give you least concern, but returns, but if you have a positive carry, definitely you'll make more money than trading on the single bets. That's always, I'm just telling, but anyhow, I'm going to run some of the things with you. What is market making? Because, see, manual traders and jobbers are doing their job. But the most important thing is how to price derivatives. Derivatives have a continuous time. I have to price my this month, next month. I have to price my call. I have to price my put. It is impossible for traders to price as volatility surfaces. Impossible for humans to price the current skews. Like an impossible to humans to calculate every second the basis points. Once the derivatives started picking up, the whole thing, machine came, the math and the machine started playing a bigger role in the things. And second thing in the market making, what we look at is called, market making consists of two things. One is the machines, the second one is math. In the math, we use called probabilities, called conditional probabilities. I am coming here, got stuck in a red light. What my brain says, immediately I call Sushil, I'll be late another 15 minutes. Because the event has triggered. When an event happens, it creates a new probability actually. So whole market making was developed actually by MIT, Artificial Intelligence Labs. There was a project in 1996, started by one of the Indian guys, Mr. Das. Actually, the market making was completely on conditional probabilities. I am talking here, next 5 minutes is a probability. Next 15 minutes, very rare, but next 1 hour, definitely not, because I had to flight to cash. The probabilities, as you increase, the time increases, the probabilities decrease. So market making is completely on market. As we know, the most important thing as a market maker is what is my inventory risk. The whole market making came from a regular vegetable business on the street, let me tell you. You go and watch a vegetable shop, he will have tomatoes, he will have coconuts, he will have bananas, he will have mangoes, and he will have different things. Each one has a different variance here. The coconuts will have a shell life of 15 days. And bananas will have a shelf life of 1 day, whereas eggs will have a shelf life of 2 days. So each product has a variance. So how to address these variances and how to control my inventory risk? Ultimately, people talk about ITC, people talk about SDFC, people talk about something. For us, we don't know where is my cash, at what instruments it is there, I don't know. Whether that instrument is giving enough returns or not. Can I move my cash much faster? Is my cash making per basis 1 second? Is the cash is making? How much is the variance on this product? Can I minimize the variance with something else? This is how the market making thing happens. See, these statistics are built on a street guy who is there on the street. So just how he is doing this, it's completely, he knows something is going wrong. He is having vegetables, which are decaying. He knows how to dispose it of it to the hotel or something and try to get his cash at whatever the cost, because I need my capital to be in the game tomorrow. And you tell me, if you start a shop, nobody knows whether who will come and attend and who will take my inventory from there. You never know. Sometimes excess inventory, sometimes less inventory. There will be informed traders, there will be uninformed traders. Because being the machines, we cannot feed all this information. There will be informed traders who will be coming and suddenly starting how the price has to move up. All these are programmed into the machines. As a designated market maker, I'm explaining you the volumes, exchanges pay us on the volumes because exchanges want an orderly market. So except in India, India also NSE pays us for market making, the ETF, and BSE also they pay. But all the international markets, market making is an official thing, and they want official market makers to bring orderly markets, because people in a distress, suddenly something news comes and somebody has to exit. There should be someone who has to put his capital and bring the markets into an orderly fashion. This is what I'm giving an example of Getco. This is the live example how Getco makes money. 450 million shares per day with 225 million round trips. Even a 1 cent per trade. That's the average profit they made in a year is 280 million net profit per day, where 30 to 40% of costs are only technology costs. The interesting thing, people look at Dilip Sangvi is the richest man, Reliance Mukesh Ambani is the richest man, Buffett is the richest man. If you look at the biggest money cash takers are Ray Dalio, James Simon, Ken Griffin, Citadel. If you look at, if you go and type on James Simon, very interesting guy, a mathematician, started at the age of 55, lost 7 years of continuous before he started his Magellan fund. Simon's continuously lost 14 years. Average take home is $2 billion, 1% take home. And he trades the markets morning starting from Australia to the close of New York in the night, rotating $63 billion. What he says is simple thing. If I can rotate my cash 2 times a day, I will own the cash in 1 year. If I rotate my cash 1 time a day, I will own the cash, 50% of the cash I will make in a year. Simple example, if you are having a stock which is 20 rupees, bid ask is 5 rupees. You have 100,000 stocks, you kept 20 lakh rupees. 5 paisa, 1 paisa is your expense. Then if you're doing, let's say, 1 lakh round trips, buy, sell, you're making 5,000 rupees a day. In a 252 days, you remove the 1 cent, it's 4,000 rupees a day. In 252 days, you're making 10 lakh rupees, that's 50% of your cash. That's what the Wall Street firms do. Wall Street firms push, when the IPOs come, you look at, they create so much of, nowadays, the push is so much. Even the NASDAQ failed on the day of Facebook IPO. They couldn't handle the orders because the push is so much, because everybody wants to put millions and millions of trades so that they can cover, the first 3 months itself, the volumes has to be rotated. Similarly, if I do 2 times a day, you own that stock within the same year. See, that's what the capital, how fast the capital has to be rotated. So the first important thing is they are racing the time to zero. That's what we always call in Stampede is race to time zero. Because Lakshmi ticks every minute. Just as a philosopher, as a devotional thing, I just say, why Lakshmi is at the feet of Vishnu, not everywhere? Because Vishnu means in Sanskrit is everywhere. The person called Sarva Vyapi. In Sanskrit, actually the meaning of Vishnu is Sarva Vyapi. Because who is everywhere is where the Lakshmi is under his control. If you look at McDonald's, KFC's, Citibank, they are replicating the Vishnu. Actually, if you are looking at McDonald's having 50 branches in Bombay, 100 branches in Sydney, and the next minute 100 branches in Korea to America they're 24 hours. Every second the burgers are made, 5 seconds. So they're racing with time. Why Americans made so much of money, why American organizations have really gone to that scale, because they're racing with time. It's a quantum physics. If I work one day, it's 8 hours. If I work the same, if I have 5 branches, it's the same day is replicated 5. If I have 50,000 branches, it is completely, it's a quantum physics, how the expansion of time is. Then only you can become like a Vishnu where money is controlled. Vice versa, if you are working for the money, then you will become, you see there is another god called Kuber, where Nar is this wall. Kuber writes on the hand. That means if you take debt from the bank, I buy a car, Rover or Jaguar, I'll be working, whether I'm sleeping also my car, my banker is making my money on my blood. See, it's which side of the coin is what everybody has to look into it. See, interesting thing about market making is the risks, costs. What are the costs? Inventory control and information. I'm not taking much time. Costs. 90% of the market makers are getting rebated because first thing is exchanges pay us back. That is one of the reasons. People think there are 3 great things in mathematics so far which got finance related, got Nobel Prize. None of the maths never got a Nobel Prize on its own. With the combination of finance, math got its Nobel Prizes. The first one is Harry Markowitz MPT theory. The second one is Fama-Finch and CAPM model. And the third one is Black-Scholes itself. A lot of people criticize Black-Scholes, saying it's frictionless, they have never counted the transaction cost. Actually, Black-Scholes is meant for market makers where there is no transaction cost. That's the first fundamental, because second thing is inventory control. Here, see how a shopkeeper on the street is controlling why he is not putting 50,000 of his cash in bananas, then only 5,000 of cash. You go to a sweet shop, why he is not putting 50,000 in rasmalai than a regular other sweets? Like, and see, he is having his mind is creating a content, it's called a distribution. He is completely coming from his distribution from his losses. And he's drawing his new distribution. Everything is a distribution process. As a market maker, we don't look at the markets at all. Because when the markets open, we control. When the markets close, we handle the machines. And when there is a turbulence, we attend. This is like a pilot, from co-pilot to co-pilot, we take that. But all the work my guys will be struggling is from night, evening 5 o'clock to 11 o'clock, making the sheets, complete binomial steps next day, because we have to plan the trade and trade the plan. The machine will trade the plan. Completely it has to be given into the machine. The sheets and the matrices, the complete hundreds of matrix sheets has to be given into the machines. And the last one is information and volatility, because always the street is smarter than anyone, and people will be getting tons and tons of informal trades. So we have to see whether I'm giving excess inventory, how I'm getting, whether I'm skewed on one side, whether I can take from something else. Suppose, actually we are a market makers on dollar rupee or something, when something is getting skewed, I just go and hit other banks and try to bring my skew back so that I'll maintain the orderly inventory with me. The 3 things to address the minimizing the risk is the Brownian process, the jump and OE process. I'm not taking much detail on it. Let me tell you the most interesting fundamental of all these processes is a formula. You can always look. This is the mother formula of all derivative traders. Please mind, there is no other holy grail other than this formula called ds equal to mu as dt sigma dz. This is the formula. ds means change of something. The derivative of something is the mean. Mean means I have an expectation, I want to do something. For every time step, the mean changes. And the sigma is my variance, and the dz is how far I'm deviating from the mean and how I have to bring it back to the mean. So this is how the business starts. I have a mean, I have an expectation, I want to be something, the time is passing. Time passes also is a price move. So how I have to bring back to the normalcy is just how we use in our mathematically this thing. I'm just showing you there. This is a Brownian motion where every path, and we believe as a mathematician, we don't think the markets have a direction. We always believe markets are random and nobody can predict the markets. We always use mean reversion processes. That means I'll explain you later, but just as the time is short, I'm just telling you, Brownian motion is what we believe, and you can only apply on a mean reversion when you have a long and short, because market makers are like a bank. We have a deposit and we lend. We never take one direction position. Then only I can maintain my orderly means between the two. And another thing is like interesting, I just compared with this slot casino machine. I think anybody knows like who goes to a casino. Every slot, as there is a 1 rupee, like in US, you have a 10-cent slot, you have a 20-cent slot, you have like a $1 slot. So we look at like in each slot has each payoff. Like in ITC will have a different payoff because of its cost. Let's say it's at 300. The bid ask, the cost will be like 20 bucks, 20 paisa. Like then like, some other stock will have, 20 rupee stock will have 5 paisa cost, 1 paisa cost. So what is the payoff and what is the cost? So each one is a slot machine, and as a market maker, we combine multiple stocks into one using principal component analysis. And now the latest thing is all ETFs. How at one shot I can trade 50 stocks using the ETF. That is the latest ETF management across the world. Even NSE is trying to push it because that brings more liquidity into the markets. This is one of the matrices. We don't trade. Actually, if you look at this matrix here, like we are connected with 6 markets there, like NSE, MCX, SCX, like CME, and DGCX. There's one matrix. We normally, if I'm long this month, next short month is called a calendar spread. Suddenly I'm at 600 basis points, and 650 basis points is my next month's short. Suddenly my cash sees there is 575 basis points, there is a long available, and I just move my cash there. I'm not trading. As a market maker, you have to understand that we are not selling and buying. We are moving our cash and increasing the spreads. If suddenly in CME, I see a short at 675 basis points, my cash moves from 625 basis points to 675 basis points. Am I increasing as a banker, am I increasing my spread or not? That's what I'm more concerned. Every time, am I increasing my cash value by basis points? This is what actually we are doing in the market making. People think market making is something crazy, market making is gambling, markets are not gambling, sir. There are so many institutions, hundreds of years, are here and running, making this as a professional business, and BFISI, banking, finance, and insurance sector completely lives on creating the values for the markets. And the markets are highly ordered and professional, developed, and every business has a risk. Every business has a risk. And here, this is the one market where you can control your risk by putting the stop losses, and as long as you know what you're doing. This is about the technology I'm talking to you about the feed handlers, how we handle the feeds. Like millions of data, like in NSE, if you look at tick by tick data, how to handle the millions of feeds, gigabytes of feeds from multiple exchanges. Then processing power. To run a matrix, I'll give an example, sir, how much processing power. To run a matrix of 20 by 20 matrix, if I want to run a 20 by 20 matrix, I need Intel at least 10-core processor, which will cost you 50 lakh rupees, that processor itself. 40 to 50 lakh rupees. If then we are the first one, thanks to my team, like last 1 year, we did a lot of research on GPU because only problem with GPU is it sits on the PCI bus. GPU can handle 2,000 cores, 2,000 matrix at a time compared to a CPU. If you are doing all your maths or your future, always move to GPU. That's my best suggestion because that's where the world is looking at. And the next one is the business logic. I told you is DS equal to mu SDT sigma dz. This is very, very important. Without understanding, don't trade this market. Please, if you don't understand, go and talk to the people what it is. Why a change of life of every step changes my mean. Mean is expectation because when you say mean, I want to be something. I want to be something, that means mean changes. Every time your expectation because of the time, because of the price change, time change, environmental change. That creates volatility, that creates how to adjust that, how even it's a life or anything, passion, this is completely how you have to understand. If you understand this, then only you can keep the markets into a normal distribution. I always give an example of Shivlinga. When you say Shivlinga, what is this? Like you see a normal distribution with a right kurtosis. Life has to be a right kurtosis, not leptokurtic. Never be a left side kurtosis where you will lose completely. How much you lose markets because you keep on putting the money. It's a power law. Because people understand, engineering students understand only two derivatives, the first order and the second order. The third order and fourth order are the skew and the kurtosis where people ignore. I don't want to see the gamma of gamma or the delta of the gamma. They don't understand. Anyhow, sorry if I'm talking much technical because I'm a technocrat. So, never be leptokurtic, you are completely finished. That's why Lakshmi is called two things, Prakriti and Vikruti, the first two names of her. Like, if it is a right cortices, it is the nature. If the left cortices, you see the earthquakes of the life. So when you look at the Shivalinga, it is a complete normal distribution with the right cortices. That's why they call in Sanskrit a sloka called Trayambakam Yajamahe Sugandhim Pushtivardhanam Urvarakam Hebandhanat Murchormuk Shemamurtat. Oh Shiva, I want to die, but I don't want to die as young because I have kids. I don't want to pluck. If you pluck any plant which is very not ripened, you'll see the milk and everything coming out of it. I want to die with my completely how I detach, how a melon detaches from its root after completely ripen. I want to go like that. So that's why the markets always follow normal distribution. We try to bring your life on trading to the right sides of the cortices than to the left side of the cortices. The co-location, event processing, that's what we also use, but we use technical analysis because I know, because you all guys will be hitting me, I am also on the other side. I have to provide the equilibrium markets because we use 200 tick, 50 tick crossing, 200 tick, 30 tick crossing, 500 ticks. We also know that's because we also know the market is making higher highs. We just simply follow Charles Dow theory is programmed into that. Because market is making higher highs or lower lows. I don't follow any other technical analysis, frankly speaking. As long as the market makes higher highs, the market will keep on making higher, unless it changes its direction. That's the first theory of the market. And we also program on that. And second thing, dynamic populating order book, we have to populate multiple orders because maker-taker. We do a lot of multiple order books has to be populated and then gives the trading decisions to the trading systems. This is a model, actually very complex model. We are one of the few guys where people laughed at me from India. They said, Venkat, why the other exchanges will give it to you? There are Americans. When I started doing my volumes in Singapore, today every American exchange is calling Stampede to come there and be a market maker. Because handling the messaging capacities, they want volumes, exchanges want volumes, messaging capability, we integrated the IPs, inter-process communications systems with the complete high-end matrix. I can handle even a matrix of running a 4,000 by 4,000 matrix can be handled, and that many messages can be handled between and switch it between the systems. That's why we can scale to that heights. Yeah, coming to the last snapshot, EMM industry. As I told you, these are the four guys, and I really admire and I learned a lot of them. I personally interacted with some of the guys. Virtue recently got listed, Getco is listed, Citadel is Ken Griffin's company, and Renaissance Technologies. These are absolutely, as I showed you Citadel video before, Renaissance is Simon's company with 160 people, with 20 traders trading the world with $63 billion of cash rotated every day from morning to evening. As a Getco is a market maker, one of the market makers, and they do, I gave you an example of their revenues previously, and Virtue is one of the interesting things, they had one trading year loss after 1,230 days, which they filed for their IPO, and they got their IPO opened recently. Thank you. I'm just giving you a brief shot of the industry. It's not just like, and I just came here just to give you a brief shot of the electronic market making industry. Nothing else is there, like, what's happening in the industry. Yes.
How's your firm different from that BAT exchange by Brad Catleyama?
I couldn't get you. What is it?
Your firm, how is it different from that BAT exchange that is in the book Flash Boys?
See, Michael Lewis has written an example of Flash Boys about front running, sir.
Yeah.
Let me give you an example when we are like one way or other, whoever. See, when Michael Lewis has written, their Virtue has to stop their IPO. Recently, they opened their IPO. The FINRA, which is a financial regulator in US, has given a set. If somebody is buying a business class ticket, he is allowed to move fast. Yeah, I'm co-locating and providing the orderly markets, and exchanges are encouraging, because if we are not there as a market maker, the stability of the markets will not be there. So the exchanges and the SEC has recognized, because in a crisis also, when the markets are falling, suddenly a news of RBI comes, the market started falling. Somebody has to be there to take your derivatives into their book. So now the exchanges are understood, unless somebody is very much co-located who can take that much of volume from across the India, it is not possible for an individual trader just to go and observe that flows. So the exchanges understood and the regulators understood that the flows, somebody has to be at co-located, and after that only there was an uproar, then there was a Senate meeting happened, and they approved that it has to, the flows to bring the orderly market, you need to have that.
Another question that come to my mind when you were discussing it, you said you make markets on dollar rupee. How is that possible? It's not allowed.
No, sir. Dollar rupee is allowed across the, let me tell you, we are one of the few companies, it took 1.5 years for me to take the permission from Reserve Bank of India and SEBI. Because being regulated by SEBI, I'm a broker, but I don't do for public, like we just do for markets, for the exchanges. It took 18 months for me to get the permission. You have to get permission from RBI and SEBI. After that, we opened the subsidiary in Singapore, where Singapore Exchange, Dubai Exchange, and all the global exchanges, even CME, officially launched their dollar rupee trades. So you can trade now, any global exchanges you can trade dollar rupee. As an Indian you cannot, but as global investors and global institutions can trade in any of these exchanges. Now Singapore Exchange controls 30% of the volume and Dubai controls 40-45% of the volume of the global volumes today.
Another question, if it's allowed. You described the Wiener process, right? You described the Wiener process and drift. How did you link it with the technical thing that you said with some tick size you will just, like a moving over crossover? I mean, it's entirely different science. It's a stochastic process, the other is a technical.
See, anything is a stochastic process. Stochastic process, from yesterday I was listening to someone. Somebody is saying I'm doing standard deviation on a stock. How can you do a standard deviation on a stock? Anything which has a deviation is a spread, sir. You have to have a mean reverting character, first thing. Whether I'm spreading means I'm doing a basis points which has a spread because I bought the stock and sold the futures, or bought the stock, sold the variance through a call or a put. So as a market maker, I'm having an underlying always. When a cash is a process of stochastic process, see my cash, see, you are keeping 100 rupees in your pocket and 100 rupees in a bank. The next day you have a deviation from your mean. What happened? The 100 is 10001, 101, but your cash in your pocket is 99.99. Nobody understands there is a skew is happening. After 5 days, the skew elaborates a lot. Unless you don't know, because people say, how I can trade. I will give an example because I will close the trade for your general interest, because a lot of guys will be trading options. I'll just tell you, because we have a lot of experience in options, like, and I'm telling you. If you are buying a call and a put, people trade, okay, they do delta trading, like normally they say, sir, I'm delta hedge. What happens? Black-Scholes says you have to do continuous trading to form a normal distribution. What happens after market? You have to trade. How you will trade? See, the Friday, Saturday, Sunday, 3 days are holidays. Example, I have a call and a put. I'm losing, let's say, 20 rupees in the call, 20 rupees in the put. That means the market has moved 40 rupees, 40 points unfair to call, 40 points unfair to the put. Technically, what happened? If I don't adjust my book, if I adjust my book, then you are adjusting your skew. Then you open in the next day morning, you are intact. This is what a regular street shop guy or a guy on the street is doing, is keeping his price intact. So tomorrow market opens, I have to be intact with the market. Unless you don't understand the continuous, this is what the mother formula for whether market making or a Wiener process, or you call it anything, stochastic process. This is the mother formula for life or any business. You have to keep your prices intact with the market from that point you entered. This is called stability ratio, whatever you call, D delta D vol or WANA or WAMA, whatever the names you call. It's as simple as that is how to keep my prices intact to the market is very, very important. Don't think that after closing out the market, I don't need to do, I adjusted my delta. Delta hedging will not give you any money, frankly telling you will lose always because you have to adjust your third and fourth derivatives, which is, then only you can be in the normal distribution. A lot of people will adjust the price. They don't adjust the time. Square root of time is volatility. You have to understand. Because vols increase, the premium increases. Vols decrease, the premium decreases. Square root of time is volatility. Square root of price is also, variance is also volatility. Both are same. You have to adjust the books. If you don't adjust the books, definitely there will be a huge skew on it.
Myself, Homish, and I would like to know if is market making different from trading? If no, how do you make money?
So market making is different from trading. Is not, what is trading, sir? Let me tell you. First, I want to explain you. Trading is nothing but if you are an exporter. What do? You buy some mangoes from here and sell it to like something in Canada or Singapore. You're making a spread. As a market maker, also we are a trader. Trader means any business is a trading, sir. I'm having, let's say, example, a steel plant. I buy the raw iron ore, convert that and sell it. So I'm buyer and a maker and a taker. Market making is actually nothing but a trading, but people think trading is only one side portion. A trading never happens unless you have a maker and a taker. So we are a market makers, are few traders. We buy the market and sell the markets and make the spread.
This is Ajit. How this electronic market trading has impacted the traditional market makers? That's one. And secondly, how the EMMs doing the better job as increasing the spread than what the traditional market makers used to do?
So let me tell you, sir, no, traditional market makers used to do a great job on the single stocks as long as the stocks are there. But who is trading single stocks today? You want to trade futures. How can you price a future? Suppose example of market, I'll give you, either you are watching a spread, let's say HDFC Bank long and your future is short. Intraday the spread contracts, because when the markets fall, I'm a market maker. I know the futures are, you are looking at technical analysis, you are shorting the futures. I have to acquire into my book. Normally, I'll reduce my basis points in my future. So I know, unless I calculate my basis, because we don't trade on price, we look at basis. Okay, I got 1200 basis points RI, until the month ending. Now suddenly the market is going down. And there is a huge selling is happening. I also know there is a trend line breakout. I also know there is a flow coming on my side. Immediately I'll drop my price basis point. It is not possible for a derivative pricing, sir. Human traders cannot do derivative pricing calls. Look at NSE, Nifty options, KOSPI options, how every second the call set puts a price. This month, next month, and multiple strike. It is not possible for humans, sir. Humans cannot do market making.
So I trade options. I just want to know how can market making be related or useful to a retail trader, because the volumes which you are talking are, a retail trader will never come
No, sir, I'm talking about it is good for retail traders to go and exit, accumulate the stock and, get out of the stock faster. We are not for the retail trader, actually we work with the exchanges. We are creating the orderly imbalances to the exchanges, so the people like you who wants to trade can always at any point of the time can exit the market or enter the market with whatever the certain liquidity. We are bringing the orderly balances. Actually, one way we are helping the markets to bring the balances. Thank you very much.